It's not like a typical blind fund where your money's spread over all the opportunities in the fund. We bring the deals in typically one by one, and people can decide whether or not they want to be in those particular opportunities.
All right, everyone. Welcome back to another episode of Action Takers Unscripted. Today we have another exciting guest. His name is Jeff, and he has been in the real estate industry for 12 years, and he has been involved in projects that's worth over $150 million, consisting of over 2,000 units. He has been involved with stabilized and value-add properties, including student housing, short-term rental, and market rate multifamily projects. Without further ado, Jeff, welcome to the program.
Well, thank you very much. I'm happy to be here.
Yes, I'm happy that you're here too. I gave a little bit of background of what you do and who you are, but I'd like for you to share with the audience who you are and what you do and where you're at now with your business.
Yeah, I started out actually a little bit later in the 12 years. I actually started in real estate about 2005. Didn't really get into commercial real estate until about 2008, and started out with multifamily and also added some student housing properties in as well. And so been doing that for quite some time. Lately, within the last couple of years, I've moved into the the private equity field, where I raise money for other people's deals, for other sponsors. So that's the latest thing that I'm doing. I have a customizable fund where people can get into all different types of opportunities. And I'm sure we'll get into that a little bit more as we go.
Okay, so if you could just share with the audience what it is that is you said private equity fund, right? Can you share what that is?
Yeah, I actually have two private equity funds, and what that is we bring people together to invest in other people's deals, and because it's customizable, my investors can diversify across many different asset types. So basically what we're doing is bringing in equity. I go out and find good quality deal sponsors, and I always have the sponsors as the number one priority on looking at opportunities. Then once I like the sponsors, I will start looking at their deals. As they send me deals, I'll look at the deals and see if that fits in with the criteria of my investors. And so we'll come in on the equity side, the LP side, and we use what's called a fund of funds model, where we come in on the LP side and invest in the deals. And I always bring in my money as well, so I invest alongside of my investors. And multifamily is one area we look in, as well as student housing, self-storage, short-term rentals, mobile home parks, assisted living, all different asset types. And with each opportunity we bring in, our investors get to choose which ones they want to be in. They don't have to be in each one of them. They can pick and choose within the fund which ones they want to be involved with.
Okay. So that's an interesting concept as far as having the sponsors choose which investment type that they want to invest in. As far as when you're looking for these sponsors and you have these different types of projects, how do you vet the sponsor themselves, and how do investors, like you said, they choose based on the criteria that you have? What's the criteria that you look for in those those sponsors as well?
First of all, that's a great question, because that's the one question that a lot of people don't ask, is the sponsors, or how to find the sponsors. And a lot of people go look at the numbers. They go and they say, wow, look at that 20 IRR, 10% cash on cash or whatever. That comes later. The first thing is the sponsor. So we want to meet the sponsors. I interview every principal on a team. I want to know what their business is. I want to know about their business. Typically, we don't want to be in deals where there's just a one-person show. We want to know what the team is all about. We want to know if they're vertically integrated. Do they have a management company? Do they have a construction company? That's not an overall requirement, but we want to know how they resolve the issues of working with property management or working with construction people. I want to know more about that, and I want to know a lot about their team. I want to know what their experience is. I want to know how well they've been doing with full cycle deals. Now, everybody that's been in this business knows that previous 10 years, you could have been doing just fantastic because the market was strong. And so I look beyond that. What did they do according to their pro forma? Did they perform as they projected? What was the reasons why they did so well? Was it just because the market helped them out and had a compressed cap rate? Or did they actually perform on what they said they were and their business plan? So I go deep into the sponsor, and then I start analyzing the deals. But that, as I said, that comes after I'm good with the business and that team.
Okay, so you make sure that you can at least trust the sponsor yourself before any potential investors want to invest in those deals. Is that correct?
Absolutely. Okay. Absolutely. Then once I'm comfortable with them, I'm going to look at the market they're in. I'm also going to look at the deal itself. I'll do a heavy analysis on the deal. I'll look over their assumptions. That's usually where the problems start out, is where they're assuming that they could do this, or they assume that they could do that, or they assume that they could get all this done in 1 year, that they could, renovate, 100 units or whatever, raise rents. Their occupancy isn't going to go down. So many different assumptions that they have in the beginning. I also want to look at what kind of debt. Debt is real important these days. I want to know what kind of debt, what's the term of the debt, what interest rates, just all different things about the debt, as well as what they're doing as far as reserves. These are the things that could really cause a lot of risk on deals, is insufficient reserves and, not being prepared for the downside. And it comes down to, how are they protecting investors? What are they doing to protect investors? Number one is, how do we protect investors? After that, then we can start talking about how we make money. But I want to know how they're protecting investors first. And that comes down to a lot of things. I've already mentioned several. It comes down to the quality of the sponsor. It comes down to the debt. It comes down to the reserves. A lot of things can be, turned around with a good quality operator that has plenty of money to back them up.
Would you say that's some of your criteria as far as risk mitigating factors that you take into effect when it comes to these sponsors?
Absolutely. Absolutely. I mean, that's all about risk mitigating. Yeah. Making money, that's a whole different thing. I mean, you could project anything. Numbers are easy. Numbers are easy. I could put numbers on a spreadsheet that are going to make everybody want to jump in and join. That doesn't mean anything. It's the integrity of the person that's making those numbers and producing those projections. Are they really going to be able to perform on those? And what happens if things go astray? In a lot of areas, we're seeing vacancies increase. We're seeing sponsors have more difficulty with collections. It's happening, and we are seeing it. So what are they doing to protect? How far down can they go and still maintain the deal and, perform on it? Yeah. A lot of times right now, we're seeing the emphasis on performance, keeping expenses down, bringing in as much revenue as possible, but running a more efficient operation. And that's critical, especially now that there is stress on the market, that it is very critical.
I see. Going into the stress on the market, have you ran into any type of deals in your real estate investment career where you had an obstacle that you had to overcome, and just that was one of the challenges. Can you share that story with us?
Yeah, if anybody says no, they haven't, then you could figure you could walk away because they haven't gotten into this business.
Interesting. Yep.
There isn't a deal that I've had that didn't have challenges. Every single one of them. The big thing is which one do I tell you about? Otherwise, we could be here all day. Yeah, the biggest challenge. I mean, you learn lessons on every single opportunity, and that's why it's good when you can work with someone that's been around the block a few times, because maybe they've seen most of the opportunities. Going into a deal where you have a gas leak, and they come back and say, oh, it's going to be on a 6-figure repair on to fix your gas pipe, and all of a sudden you say, oh, wow, I didn't budget for that. Well, how often do you budget for a gas pipe leaking? But the thing is having reserves, and being prepared for the unknown. And, I've certainly had that many times over. We've had deals. Well, we had one deal where even though we had a budget, we had $1.5 million budget for capital, there was other things that kept popping up that were major things, like the gas leak I just mentioned. So now all of a sudden you're having to squeeze a little bit because maybe you didn't raise enough money. And in that one deal, we didn't raise enough money to do all the other major things that needed to be done. And when you're dealing with the lender who's providing that $1.5 million, because that's what they were doing, they were providing that for us. That was an allowance, so we had a CapEx allowance. So now we had other things go wrong that weren't on that list. And so you're squeezing to get that. One time we sold off some of our GP shares, actually. The GPs all gave up some of their shares so investors could actually invest in the GP and get more ownership in order for us to raise some extra money for some of these items that we didn't prepare for, which was a mistake on our part, not raising sufficient money. So instead of doing a capital call because we needed money, because investors were our biggest concern, we sold off some of our own ownership to investors. And that way we didn't have to do a capital call, but we got done what we needed to do. And it ended up being an extreme successful situation.
Well, you're doing what you can to protect the investors, as you stated earlier. You do what you can to protect the investors.
And that's what we look for in sponsors, is those that are willing to give up something from themselves in order to make it right for investors. And that's one of the things when we're looking at sponsors. Have they done something in the past? Maybe, I've done other deals where I had to loan the property money, my own money. I've put my money in the deal to get over a hump. And then once we got over the hump, I could get my money back usually. And it doesn't affect the investors. So that's what we're looking for always when we're dealing with sponsors.
As a fund-to-fund manager, you stated you're pretty much a limited partner in a deal and not a GP or a general partner, right?
That's correct. For the most part, yes.
Yeah. And then so you're finding these sponsors, you're getting these deals from these sponsors, you're vetting the sponsors, you're vetting the deals, so you're not involved in the project itself as much as a GP.
Mm-hmm.
Okay.
Right.
So the general partners, they're typically the ones that do the boots on ground, do the project management, do the asset manager, investor relations, et cetera, et cetera. Mm-hmm. As a fund-to-fund manager, you yourself, you're just dealing with your investors. Those investors vet the deals themselves as well. And then based on the numbers and based on the relationships that you have and build with these sponsors, they'll invest their money with, or invest their capital with, some of the deals that you bring to the table. Is that correct?
Yes, that's correct.
Okay. All right. Easy day. So in that case, have you had anything in regards to your let's say your typical deal that you've dealt with recently, what type of what do the numbers look like in regards to that? And or do you have any project that's pending right now that you would like to share with the audience?
Well, I mean, we have, there's no real typical deal. I mean, I could tell you what we typically look for, but it's going to depend on the different asset types. Some of the deals we're looking for have a higher cash flow, and other deals that we look at have more capital appreciation. Typically, commercial real estate, especially multifamily right now, you don't see a lot of cash flow. We are looking at possibly investing in some ATMs, which investing in ATMs, it's all cash flow. It's nothing but cash flow because at the end, the machines are junk. So, but you could be getting somewhere around a 2% a month cash flow, like a 24% a year on the cash flow. After 4 years, you have a little over 4 years, you got your money back. And then if it keeps going for another 3 years, that's all free money.
Right.
But there's other deals where you may not see any cash flow at all in the beginning. And like a development, you get into development deals, you're not going to see any cash flow. You may not see it for 2 years. And then you get cash flow, and then the sale of the property, you get most of it at the end. So we're always looking for a variety to offer to investors, and then investors can self-diversify by deciding where they want to put their money. And they don't bring their money in until there's an opportunity that they want to be in. So if they go into one opportunity that we present, they allocate the money to that. So now that money is committed. Now, if they want to go into another deal, they have to bring in more money to allocate to the next deal. So it's not like a typical blind fund where your money's spread over all the opportunities in the fund. We bring the deals in typically one by one, and people can decide whether or not they want to be in those particular opportunities.
Okay, got you. So I know you stated in regards to cash flow and cash flow versus appreciation, and this market right now is kind of tough dealing with the receiving cash flow in multifamily projects. Are you focused more towards appreciation, or are you more focused towards the cash flow side of things?
Well, I am trying to get some opportunities in with higher cash flow, and that's why I mentioned the ATM machines, because they are the higher cash flow. There's other opportunities that I'm looking for both. For the most part, I do want some cash flow and as well as the capital appreciation. That's mostly what I see my investors want. There's some of them that they may be investing with their self-directed IRA, and so they can't do anything with the cash flow anyway, so they don't really care. So if they could get a high capital appreciation, that's fine too, because they can't touch that money for years anyway. So it just depends on each individual's situation. Some people want to get into the investments because of the depreciation, the taxes they get to write off. So some people, are making too much money on some other investments, or they had some other opportunity and they need to write off some taxes. So they get in it, for those reasons. Right. Each individual investor is different.
That makes a lot of sense. I think that's a great way to segue into our next segment of the episode. I think you've shared a lot of I learned a lot, like within the last few minutes. Like I'm trying to be a sponge, as you say, and just soak it all in, because I think just doing this little short conversation that we have, I've learned so much in regards to what you do as a fund-to-fund manager, and that's something that I'm looking forward to doing within the next couple of months, and being a fund-to-fund manager and raising the capital to invest in other deals. So vetting the sponsor I think is key and building that trust and letting the investors know that invest with you on these projects, that these sponsors are the real deal, have been in this, have the experience to give the investors their capital back plus more, and do what they can to ensure that they protect the investors. Another key point that you made there. So with that being said, I'm just going to go ahead and go to where we talk about actionable steps that that new investors or potential accredited investors want to do on these deals. What can we do? What are some strategies or some tools that you can provide to the audience on what they can do to get to their next step in life, to get to their next step in real estate, or just to overcome that fear of moving forward?
Mm-hmm. Yeah, I mean, the fear, a lot of that comes from lack of education. And I think getting educated and learning about the business gives you that ability to reduce a lot of risk. So I tell people to be listening to podcasts, such as this, but also reading books. There's some great books out there that could give you some real basis on information. For those that are interested in actually being either a passive investor or an active investor, the book I usually recommend the most is Brian Burke's book, The Hands-Off Investor. If your audience hasn't read that, either way, if you're going to be a passive investor, it's a great opportunity to see all that's involved in a syndicated operation. Mainly multifamily is what Brian is focusing on. But for those people that actually want to be an active investor, it still gives you a great idea on all the different complexities of the business. And, it's a good start to read that book and see all that's involved. But education is number one. Getting educated. If you want to be an active investor, I always tell people, find somebody that's doing what you want to do and has experience doing that. That's a few steps ahead of you, and find a way to be a resource for them, find a way to help them, and be just able to hang out with them. You don't want to be a burden on them, but if you're able to help them, make phone calls, maybe you are boots on the ground on a market they like, maybe you have the time to go out and fly out and check out properties or whatever, being a resource to that person to learn the business. If you're looking to be a passive investor, is networking, finding people that you're willing to work with. I mean, of course, I'll plug my business as far as looking for someone like myself that you could invest with that's doing all the work for you.
Right.
I know a lot of high net worth individuals that love this thought of investing in real estate and all the benefits of real estate, but really don't want to do all the work that people like myself are doing, and actually doing the kind of due diligence necessary to protect yourself. A lot of times people will look at the numbers and they say, oh, those numbers look great, I'm going to invest. Well, like we've discussed earlier, those numbers could be manipulated in all different ways. The key is, doing your due diligence. If you don't have the time, the energy, or desire to do it, then you find someone like myself and invest with us. And that way you've got another set of eyes looking at things and are protecting yourself.
That's perfect. I think networking is very important, and to get to that next step, to get to that next level. You also stated that getting the Hands-Off Investor book by Brian Burke. I think that's another way of overcoming your fear and just learning on the fly as you go. You can't move forward if you continue to sit in the same place and continue to stay in that same place and want to be there just because of fear and the fear of unknown. And you start with educating yourself. So again, Jeff, it's been a pleasure. I enjoyed the conversation today. Where can people learn more about you and what you do?
Okay, first I want to give your audience a free ebook.
Okay.
And This is questions to ask deal sponsors before you invest with them if you're planning on coming in as a passive investment. Okay. But good questions to ask. And even if you want to be active, it's good questions to think about as somebody that's going to be actively involved in real estate. And you could get that at sigcre.com/sponsor. And you'll be able to grab that book and get some information on it. Awesome. And you could get a hold of me at jeff@synergetic.ig.com. You can go to my website, synergetic.ig.com, and learn about me and get some more information there.
Awesome. Again, we'll put those links in the show notes along with the book by Brian Burke. We'll put that in the show notes for the audience. Again, Jeff, thank you for your time today. I appreciate your time. I really did learn a lot today, and I enjoyed this conversation with you.
Well, thank you. I always enjoy having a conversation. Thank you.
Take care.